put full screen.
There you go. Yeah,
Okay.
perfect.
All right. Thank you so much. So yeah, we'll look at the money and capital markets, the sources of funding in the local setup as well as the international market. So as if you're, when you're running a business, financing is very cardinal to any type of business that you're running. So I took the privilege of trying to appreciate the audience I was going to have on this platform. We have people from different backgrounds and setups. So we have people from the medical field, we have people from the business, agriculture, etc. So with that background, I thought of approaching this segment or this session in a way that would be well receptive to everyone on the platform. So we won't go into a lot of calculations and things like that. But what is very cardinal is your take home from this session should be the aspect of how you can source funding from these two markets that you're going to look at this morning. So when you're looking for funding, basically it means that now you're going in the financial markets. So for those of you who've done business studies, you know that there are different types of markets out there. And when you start looking at financial assets, it simply means that now your focus is in the financial markets. So when you're looking at the financial markets, basically, this is the market where financial instruments are bought and sold. So what I've done is here, I've just basically shown a graph for those people who are not conversant with what exists in the financial markets to try and appreciate from a glance what this is all about. So in the financial markets, this is where you find the financial institutions. You also find stock markets. This is where you also find debt security markets and also derivative markets. But looking at what we're interested in, we are focusing more on how to source funding from these markets. So the derivative markets today is something that I want to touch on. We'll look at the debt security markets, stock markets, and also the financial institutions. So why is it very important for you to know these markets? So this market enables you as a company, or if you're running a business as an individual, to source funding for your business. Now, in each respective of these segments that you have stated, there's special vehicles that are used for you to source the funding. So you need to know why you're looking for that funding at that particular time and which market to target for you to meet your goal in respect to the funding that you're looking for. So in a nutshell, when you look at the financial markets, you can further look at it from different angles. There's what you call primary and secondary. I won't go into detail into that. Then there's also what is called domestic and international. This will come in handy because as we are looking at this, the money and capital market aspect, there comes a time when you go beyond the local market in respect to the money market and appreciate or access other vehicles in the international markets. So as we are looking at money and capital markets, we'll also sink into the domestic and international markets. As I earlier stated, the derivative markets is something that we want to touch on. So what is money markets for starters? So for money markets, this is a market where you access financial assets that are utilized in a short period of time. So for example, these are instruments that you raise for a short period of time, and this is usually between 1 month and 12 months. If you go beyond 12 months, it simply means that now you cross over from the money market to the capital market. So the difference between these two markets is usually the tenure in respect to the financial instrument or assets that you're interested in. So for the money market, these are sources of funding for short period of time or things that you need operating aspect in an organization. But when you look at the capital markets, when you cross over now to capital markets, you are focusing on growing your business. Okay, so you move away from the operating aspect and start focusing on growing of the business. So basically, these are the two salient differences between the money market and the capital market. So when you're sourcing for funding, for example, maybe you have a deficiency in respect to find funds to buy your stock, okay? The kind of funding or the asset that you're going to source out for will fall under the money market. Reason being, that money immediately its source, it will be utilized to buy your stock that you need, and within a short period of time, that stock will be sold out, and you'll be able to pay back that. For example, if it was a loan, you pay back the loan. But in a situation where maybe you want to open another branch in another town, or you want to cross over to another country, and you need a lot of capital for you to start building up structures, buying the equipment, then now you cross over and go into the capital markets. So in the capital markets, you'll be looking for funding that will help you get the equipment. Then you also be looking for funding that will help you build your structures, and also maybe get your mobility vehicles. So basically, these are the two salient differences, and the main objectives should be identified from the inception of going in the market to try and assess funding from these markets. Now, what are the salient sources in those markets? Okay, we'll start with the money market. So in the money market, I've settled for the main salient vehicles that are used in this market. We have the trade credits, we have working capital loans, we have commercial paper, and we also have secured loans. Okay, so for most of you who are into supplying stuff or in the market to sell goods, okay, trade your credit comes in handy when you have limited money for you to purchase the imports of what you're going to use to produce whatever you're producing to offload on the market. So how how does it work? Okay, how does trade credit work in the market? So as an entity, you establish, say on a monthly basis, the kind of input that you need, quantity of input that you need for you to produce what you want to produce. Okay. So after establishing the quantity that you need, you also establish the amount of cash that is usually available on a monthly basis for you to purchase the inputs that you need. And when you realize the deficiency in respect to the two, you can identify companies that you can have an agreement with, so that on a monthly basis, you can be getting those inputs on credit and then only pay after a stipulated period of time. Okay. So for example, you can get your inputs at the beginning of the month after production, and once you have adequate money now to pay the supplier, that's when you pay the supplier. So trade credit comes in very handy when you have limited cash to buy your inputs, or sometimes maybe you may be overwhelmed in terms of the demand on the market. And with the increase in the demand of the market, you might be limited in terms of cash available to satisfy that increase in the demand in the market. So you can settle for this kind of arrangement in the market. So the goodness with this arrangement is you can continue production even when you don't have money to purchase your inputs, okay, based on the credit arrangement. And these arrangements, you are guaranteed, once you sign with the supplier, you are guaranteed of sustained operations, okay? So you know that at any given point in time, regardless of the demand that you face on the market, you'll be able to satisfy that market once you have this agreement in place. Then another thing, assuming that during your operations, and you have adequate finances to buy your inputs, then you realize that no, there's something that is very urgent, or that's something very critical that you need to attend to, and you need to free part of that money that is available. You can go into this kind of arrangement, trade credit, where you can get some money that would have rightfully allocated to buy your inputs and utilize that money for that upcoming event or uh, uh, project. Okay, so this kind of uh, financing is very, very cardinal, especially if you are into production of goods which need a lot of input at any given point in time. And one other thing that should be aware of, you need to have very good working relationships or business relationships with your supplier so that your accessing of those inputs from those supplier is sustained. Now, why am I saying so? Assuming that the first time after signing the agreement, the first time you don't honor your obligation, okay? You get the products and you don't, after selling your products, you don't honor your monthly obligations of paying whatever has been agreed upon. The second time again, they might give you some allowance to say, okay, maybe something wrong happened this time around. So they might give you a benefit of doubt. So extend this trust maybe to the following month. And if this continues, you end up straining the relationship between you and your supplier. And then in the long run, you end up losing this kind of favor that you can get on the market. Okay. So once you get into this kind of agreement, it's very cardinal for you to ensure that you adhere to the agreement. Once you utilize those inputs and you make your kill through your sales, you settle your obligation as soon as possible for you to continue enjoying this kind of arrangement. So basically, that's what relates to trade financing. Then there's also what is known as working capital loans. Okay. So for most of us, even at individual level, we are used to, when you're looking for funding, the first thing we think of is a loan. Okay. Because that's what we are accustomed to. This is a traditional way of uh, us raising funds or accessing somebody else's fund for us to advance our projects. So working capital loans, from the word itself, working capital, it simply means that you are there need at that particular time to ensure that the operations are running. Okay, so this is a situation where during the course of the month, you are in need of finances to sustain your operation aspects. And instead of settling for trade credits, you decide to settle for working capital loan. Okay. Now, for working capital loans, these are sourced mainly from the commercial banks. Okay. This is where you know that you have good standing with your financial providers. That's the commercial bank that you bank with. You know that your balance, your bank account is very good. You've never gone below the threshold in terms of the bank account, unless maybe where there's an agreement with the bank. So with you now having that comfort, okay, of saying that you have a good relationship and your balance account is very good most of the times, you can approach the bank to assist you with this kind of a loan. Okay, so there are two ways in which you can approach this sourcing of funding. There's where you just need a single funding at a given point in time. So, for example, maybe I'll give an example. I'll keep on going back to the production of goods. I'm trying to avoid the services aspect, okay? Because the input in the services is a bit dicey. But for goods, all of us, we know that for something to be produced, there are things that have to go in that commodity for it to be a final product. So it's very easy and ideal to give this kind of example. So assuming that, again, I'll give that example where during the course of production, you have an increase in demand for your whatever you're producing and offloading on the market. And you realize that you need, okay, to increase the production for that product at that given point in time when the demand has increased. So what do? You can approach the commercial bank for that single loan to ensure that you increase your production for that one-off demand that has existed in the market. Okay, so this is what is known as a single loan. This is due to something that has triggered in the markets or in the operations for you to source this kind of funding. So depending on the agreement with the bank, I'm sure most of you have already accessed this kind of funding from commercial banks. You can agree to pay it once off, okay? Or you can spread the tenure of the loan such that you pay in installments based on what you think you can manage to pay at a given point in time. Okay. Now, there are times when you know that most of the times the demand for your product is very abnormal. Okay. So you know that you usually have a spiral, a spike. Okay. So you have, there's a time when you have a boom, you have, then you have also a slump. But most of the times you realize that at some point in time during your operations or the time that you're floating on the market, there are times when you have a boom in the market. So once you do that analysis from the production point of view and from the sales point of view, you can now make an agreement with the commercial bank. Okay, you make an agreement with the commercial bank to have a line of credit. So you determine how much you need during the boom. Okay, so based on how much you need during a boom, you can now sign an agreement with okay, you can now sign an agreement with the commercial bank based on the amount that you projected that you'll be needing at particular times. So what does this entail? So that credit line will be open. You are at liberty to access it or not to access it. Okay, so you're not penalized. You won't be penalized. It's just on paper. You agree that whenever you need that kind of money, you go to the bank. The bank won't even hesitate. They won't start asking you for this and that and that. No, they know that once you go there and ask for that money, immediately that money will be advanced to you. And the bank will also be wary of the fact that there are these kind of agreements that they have, for example, with you, okay? And they'll always be wary to make sure that that money is already available whenever you need it. So that's the difference between a single loan and a credit line. Credit line, you know that you are assured whatever happens, you can access the money from the bank. And you even know the maximum, the threshold that you can access from that bank. From a single loan, it's an issue of negotiating at the time that you want to access that loan, and then also agree on the modalities and the terms in respect to that loan. Okay. Then there is what is known as the commercial paper. This is not very popular on the market, in the financial market. Usually, this is done between very big entities and also amongst the pension funds and other big entities. So what does this entail? Okay, assuming that you're in need of funds at a given point in time, and this has got nothing to do maybe with the production of goods, and also maybe has got nothing to do with maybe paying of salaries and other operational issues, but you really need that money. Okay, what you can do is you can issue what is known as a promissory note. Okay, this promissory note is as good as it's not really a treasury bill, it's not really a bond, but it's just a promissory note where once you issue it and another business entity buys it, you are assuring that other business entity that you pay back the amount of money that you've taken from them after a specified period of time. In a nutshell, it's like just borrowing from another entity. Okay, but you use what is known as a promissory note. Now, who are the main players in this market? So that even when you decide to issue a commercial paper, you should know you should know the players in this market. So usually in this market, the banks are also interested in buying promissory notes from companies. You'll be surprised. Huh? So most of the times we're the ones that get money from the banks. So banks are also interested in this kind of arrangement where they buy promissory notes from organizations. So you can issue a promissory note and give it to the bank who buy it, and then you access the funds from the bank. Insurance companies also, they are very active on this kind of asset. If you look at the nature of insurance firms, the insurance firms, they get what is called a premium on for insurance. So they look for different ways of how they can ensure that that money is kept safely and accessed whenever it's needed by a claimant. So this is one of the assets that insurance firms are all interested in. Same applies to pension funds. Pension funds, this is a pool where funds are contributed on a monthly basis. So for those who work, they contribute money on a monthly basis through different funds. And then there are also those who just want to prepare the retirement aspects so that at the end of retirement age, they'll be able to have funding as well. Those also contribute in such funds. Now, the managers of these funds have to ensure that they keep this money as well as grow this money. Why is it very important for them to do that? Okay, so if you look at the pension fund, it's got different categories of members. There are those who are just getting into the fund, and then there are those who are exiting the fund. Okay, and then there are those who are just claiming during the lifespan of the fund. So the fund managers have to ensure that they have different types of assets on the fund, which for those immediate demand claims, they'll be able to discontinue those assets that they've invested in, okay, within the money market. and pay the claimant. Then there are also those assets that are locked in for a long period of time, where they know that at the end of a period, say for 10 years, okay, they would have known that this is the number of people that will be in a position to access these funds after 10 years. So they'll lock in that money. However, depending on the kind of products or vehicle that they've invested in, okay, there are some products, despite locking them in, they'll be able to be getting an interest during that investment period. So we'll talk about this in detail. So when you look at the commercial paper, this is something that falls for those immediate demand claims. Okay, so usually these commercial papers, they are issued on a short-term basis. So as an entity, you can issue it. The pension fund will be interested in it. Okay, they'll know that maybe on a monthly basis they usually pay so much, so they might lock in the money and raise a bit of money. Okay, and then at the end of the month, once you pay them back, then they'll be able to pass on those funds to the claimant for that respective month. So these are also very interested in commercial papers. So if when you decide to issue a commercial paper, insurance firms and pension funds, they're usually interested in, depending on how soon they'll need the money to pay those immediate demand claims. There are also businesses when they have excess liquidity, okay, on their balance sheets. They wouldn't want it to be lying idle in an account. So when such an opportunity rises where they can they can make some money through you, as you are also thinking, as you are also utilizing the money through, you give them the commercial paper, you get the money. At the end of the day, there's the interest component. There's a cost for you to utilize their money. So they'll give you the money. So instead of them just keeping the money in the account, at the end of that stipulated period of time, according to the promissory note, they'll get back the money, and you will also utilize the money to achieve your short-term goals. Okay, this is a very good vehicle that you can use, but the only challenge that is there is you're not guaranteed of raising the intended money in the market. Why am I saying so? It's dependent on if you're looking at businesses, as I've already stated, this is dependent on how much liquidity is available that these businesses are not utilizing at that moment. Okay. For insurance firms or for pension funds, insurance firms, they might also they also have to look at the claim trends in respect to insurances and also the pension funds. So depending on the trends, they might not have the money that you'd be looking for at that particular period of time. So it's a good vehicle, yes, but the amount of money that you'll be looking for on the market might not be guaranteed. So far we've looked at the trade credits, working capital loans, commercial paper. Then the last one under the money markets, what we have is secured loans. Okay, so for secured loans under the money market, so this you can have loans under the money market, you can have loans under the capital market. Remember the two different the salient features that make a vehicle fall under money market and capital market is usually the tenure. Okay, so under money market you can have secured loans as well. Now, secured loans means these are loans that are backed by collateral. So what kind of collateral do you use when you're looking at a short-term loan? Okay, you can't, as a business, you can't risk your building that you're operating from just to access short-term financing from the bank. That is very risky. Okay, So under this arrangement, the kind of collateral that you utilize trying to locate the slide. There we are. So the kind of collateral that you utilize is basically your accounts receivable. Okay. So this accounts receivable is relates to a very good example. Again, I'll keep on going back to the goods market. Okay, for an entity that is into producing goods, and then they sell maybe things on credit, and then wait for a month for them to get those monies. Okay, so once those goods are sold on credit, on the balance sheet, those are recorded as accounts receivable. Okay, so this is just basically giving out your goods on credit. So once you determine how much you expect to get, say, at the end of the month, you can utilize that amount to access it now from a bank and then pledge it with the bank for the bank to get that money at the end of the month. Okay. So this kind of vehicle helps you to have your money readily available that you would have ideally gotten at the end of the month. You get it now through the commercial bank. Okay. Then you can also utilize the inventories. Okay, whatever you have in stock, you can also utilize it as collateral. Okay, so how does it become in handy as well? Okay, assuming that maybe on a monthly basis you usually sell 1,000 quantities of whatever you're producing, then in stock you have maybe 20,000. Okay, so you know that 19,000 that is in the warehouse, you won't have access to it in terms of money. And you know that at that given point in time, you are really, really in their need of money. You can utilize that excess 19,000 inventory in the warehouse to get money from the commercial bank. So you can place it as collateral with the commercial bank and access money with those 19,000 items that you have in the warehouse. So this short-term secured financing comes in handy in the aspect that it enables you to have the funding that you ideally would not have if you had to sell in the market or wait for the payments to come from those who bought goods on credit from the entity. Okay. So basically, these are the salient vehicles that you find under the money market. Remember, the vehicles that you're looking at, these are vehicles that you utilize to source funding. Okay. But if you are basically just in the market to invest, there are other vehicles as well that you can discuss. But for the aspect of sourcing for funding, we will limit ourselves to these vehicles that you utilize to source funding from the market. So with that stated, we can now move to the capital market. Okay. Any questions before I move to the capital market? Are there any questions? Any questions?
If you do have questions, you can go ahead and unmute yourself and ask them live or ask them in the chat. It's completely up to you.
Okay. All right. So let's move to the capital markets. So most of you, I'm sure you'll be interested in the capital markets. Okay. So under capital markets, there are a number of vehicles that you can utilize when looking for funding in the market. There's what is called debt security from the word itself. When you access this funding on the balance sheet, it will be recorded as debt. Okay. Then there's also what is known as equity funding. This is where you're trying to build your capital base. Then for startups, entities, the venture funding comes in very handy for you. Okay, so we'll look at it in detail so that you also appreciate how you can raise your, you can source funding using this vehicle. There is private entity as well. This is good for already established entities, and they're doing very well, or they've been operating very well in the past. Because the private, the companies that would want to invest in terms of private entity would want to appreciate where the company is coming from for them to be comfortable to place their funds in such a company. Then there's also what is known as lease financing. Okay. So lease financing, this has become very common across Africa. Looking at these entities that are involved in projects. Okay. So those who are doing constructions, those who are doing in the medical sector as well. This is very handy. Okay. We appreciate how this comes in handy. Um, So basically, lease financing comes in handy when you're doing capital intensive programs or uh, projects. Okay. Then we also have what is known as the long-term loans. So basically, the difference between secured loan and long-term loans is just the aspect of tenure. Otherwise, everything else remains the same. So let's first appreciate the debt security markets. Okay. So for most of us, nearly every country has a central bank, right? And you know that the government is usually in the market trying to raise money through what is known as the bonds. As a company as well, you can use bonds to raise money from the market. So basically, a bond is just a debt instrument that you as a firm, okay, you can package it and issue it in the market, and in return, you get money. Okay. So as an entity, you issue the bond, the public buys the bond, and in exchange, you get the money that you need to do whatever you want to do. It could be uh, opening another branch, or maybe moving in a foreign market where you need a lot of capital for you to start what you want to start in that market. Okay. Now, you need to appreciate what it entails when you issue a bond. Okay. So, when you issue a bond, you know how much you want to raise. Okay. So, the value of the bond, the total value of the bond at the end of the day, once you issue it, will help you address or achieve the goal that you want to achieve in terms of growth of a company. Okay. Now, what is it that you look out for when you are preparing this bond? Remember, you are getting these funds from the public, so it simply means that there is a cost attached to these funds. So when you issue this bond, the public would be interested in knowing how much they'll be getting in terms of interest. And this interest is usually not at the coupon rate. Okay. So from inception, once you issue the bond, you will know also from your balance sheet how much it will cost you, say, every 6 months or on an annual basis in terms of paying interest, which is stated as the coupon rate. Okay. So at the beginning of issuance of the bond, the public would know how much you'll be paying them. Or it could be semi-annually or annually. And then also even you, okay, as the company that is accessing these funds from the market, you will be able to plan. You will know how much at a given point in time you need to pay out to these respective bond holders. Okay. So the interest rate formula, this is always tabulated on the bond contract. Then even the payment debts, okay, the coupon payment debts are also stipulated. So the goodness with the debt security, everything is tabled for both the issuer and also the person buying the bond to know what they're getting into. Okay, that is the goodness of this arrangement. So everything is laid down on the table. So as you go in this market, you can also plan. Okay, it helps you to plan how once you get that money, at what point you need to ensure that you divest something to pay those people holding on to your bonds, and you also appreciate how long you hold on, utilize the money before you pay back the principal. Okay. Now, the goodness with the bond, you can decide to discontinue this arrangement. It's called a co-feature. Okay. So depending on if you're not very sure with the outcome in respect to what you want to invest in, once you get those funds, you can leave it open, put what is known as a co-feature. This gives you the right, okay, as the bond issuer, to go back in the market and get back your bond before the maturity date. Okay. And this will help you at least cut down on further payment in terms of coupon payment, interest, and also the other embedded costs that relates to utilizing the bond holders funds. So this is very cardinal. The core feature is very important once you issue these bonds, so that when you have the leeway for you to discontinue this kind of arrangement, you can go ahead and discontinue. Uh, what do you want to the funds? Then you also have to be wary of the fact that once you issue these bonds, there is a tax component that you need to pay. Okay, there are legal obligations attached to the issuance of these bonds. Apart from the coupon interest that you'll be paying, the government also wants to get some funds in respect to tax remittance. Okay. Then you have to ensure that you oblige to the settlement date. You couch when you're supposed to pay the coupon payments, and you have to ensure that whatever you've invested in, at least it gives you adequate money to pay those coupon payments as they fall due. Okay. So this vehicle is very good, especially if you have a very big project. Okay, you can easily access the funds from the public. Now, is it that you do it directly? No, you have to find a, an entity that will package the bond for you and go in the market and sell it on your behalf. So a very good agents in respect to this are commercial banks. So commercial banks will usually come in very handy. They will package it for you and then sell these bonds on the market. Okay. So basically, this is what it entails when you're looking at this market. I've already stated there's a 10-year in respect to the bond. So from inception, you know how much the public will be holding on to your bonds. And then you also know how long the public will be holding on to the bonds. And you also know how much you access from the market for a given period of time. So the term to maturity is also something that you know from inception. Okay. So apart from the debt markets, debt securities, you can also access funds from the stock market. Okay. So if you look at Africa, we have about, if I'm not mistaken, let me just, yeah. In Africa, we have 29 stock markets. Okay. And then the last time I checked, the largest three stock markets are found in South Africa. Okay. Now, you can issue. Are you aware that you can go outside your country and issue shares in another country? So you can do that. Okay. So depending on your appetite in terms of what the quantum that you want to raise, you can enter other markets as well and issue your securities in those markets. Okay. Now, how does it work? So from inception, you know how much you want to raise. And based on how much you want to raise from this market, you determine the issue price. Okay. This is the amount that you're going to sell each respective share on the market. Now, depending on the issue price and the quantity that you are going to offload on the market, you be in a position to determine the total sales produce that you raise once all those shares are cleared on the stock market. Okay. Now, the first time of issuing these shares is usually known as initial public offer. These shares can also be traded on what is known as secondary market. So that is what I was trying to avoid in the beginning. I told you there are other markets as well. You can look at primary and secondary, but I don't want to go into that. All I want in this segment is for you to appreciate the different vehicles that you can utilize. Okay. At what level, whether primary or secondary, for now, we want to look into aspects. But so the first time that these shares are issued is known as the initial public offer. And if you want to look at those terms that I'm trying to avoid, this is called the primary. Okay, and the primary market. Okay, so from inception, know how much, for example, if you're in Nigeria and you want to open maybe another entity in the neighboring country, you can determine after visiting that country, you look at what you need in terms of buildings, in terms of equipment, in terms of human capital. You determine, you come up with a budget in terms of determining your existence in the market. Okay. So once you determine how much you need to go in the neighboring country, you determine the price. However, when you determine the price, you have to look at what's obtaining on the markets, on the stock markets, the that you want to sell those shares, as well as you also appreciate the value of your existing company. Okay, so if the value of the existing company is very good, then even the issuance price will be uh, lucrative. But if it's just on average on the low level, then even the price will be low. So the lower the price, the more shares you need to sell if you need a lot of money. And then if the higher the price, the at least you won't be forced to sell a lot of shares in the market, because just a few shares, depending on the price, if it's high, you'll be able to raise your funds. So you need to appreciate those aspects as you are raising your funds through the stock market. Now, as you are issuing those shares, you need to know, okay, what are we looking for in terms of shares? Do we want, once you sell those shares through the stock market, okay, most of the times the shares that are sold on the stock market, those individuals or entities that buy those shares become part of the shareholders. Okay, they become part of the shareholders of your company. Now, depending on what kind of rights you want them to have access in terms of decision making, uh, whether they'll be getting dividends or not, and also uh, appreciating the share growth value, you determine the kind of shares that you offload on the market. So there's what is known as common shares and what is known as preferred shares. Okay. So for common shares, this is usually what is commonly issued on the market. Okay. So once you offload those shares on the market, those entities or individuals that buy those shares, they immediately have ownership in respect to the rights in the company. So when you have your annual AGM, they have the right to participate in making decisions at the AGM in your company. Then when it comes to receiving dividends, okay, remember you are running a business, and this business at the end of the day, if you are registered on, especially on the stock markets, you'll be obliged to be paying dividends, okay, depending on the kind of shares that you're offloading. So for common shares, it's not a given that you always get dividends. This is dependent on how profitable uh, the company has performed. Okay. So assuming that, I'll give you an example. Most of the companies during the COVID pandemic, they were having challenges in terms of making profits. So most of them, they were just barely surviving for them to operate, and most companies closed down. Okay, so during this period, uh, dividends were not paid for most of the companies. And this is something that you have to be wary of when you issue these kind of shares, that when the company is not performing very well, these shareholders won't have access, or they won't get these dividends because the company would not have made any profit. Okay. Now, assuming there is liquidity, okay, I'll give you an example during COVID pandemic, okay, when it was very rampant. At least now, uh, it's become part of us. We know how to handle it. So that time when it was very rampant, most of the companies closed down. Okay. So for companies that were uh, listed on the stock market and they had issued common shares, okay, those holders of those common shares were the last people to be paid. Okay. So once you issue this kind of shares, you know that those holders of those shares, once you wind up as an entity, they will be the last people to get payments. Then preferred shares, this is where these are people who are just interested in the investments. They don't want to take part in whatever is happening in the company, them as long as you give them their money. Okay, they have no rights, they have no voting rights, they don't take part in decision making. However, there is a catch by virtue of them not taking part in whatever is happening in the company. So the payments for not taking part in the making decisions in the company is giving them fixed guaranteed payments at regular intervals. This feature is similar to the bonds. Remember, when you issue bonds, you have to pay coupon payment at specified periods. So under preferred shares, you have to pay these shareholders, whether COVID or no COVID. These holders have to be paid. So you have to be very wary of what kind of shares you want to offload on the market to be on the safe side, depending on the kind of risk appetite you have. Okay, if you are risk averse, you might go for this kind of arrangement. Okay, so during when the markets are not doing very well, this kind of shares, this kind of arrangement, the dividends have to be paid. Okay, and these are agreed upon amounts from the inception of investing in the company. Okay, and then when there is liquidation, these get preferential treatment. They get their payments before the common shareholders get their money. Okay. So basically, these are the vehicles you can use when you need a lot of money to grow your company, or move to another country to go and establish your existence there. You can utilize equity financing. You can also utilize the debt security financing. Now, there is one that has become very famous now, very common in Africa. Okay, this is what is known as the lease financing. This financing has become very common at the individual level as well as the company level. Okay. So basically, what this is as a company, you might want to have access to certain assets, but not necessarily have that money at that given point in time. So what do? You identify an entity that has those assets and then agree with that entity for you to have that asset as you need it. Okay. Then pay the money based on the agreed upon time frames. Okay. So these kind of arrangements in a situation where you're there need, especially of capital capital intensive assets, you can go into this kind of arrangement where you access those capital intensive assets and then start paying over a period of time. So there's three salient types that you'd find under this category is what is called finance lease, operating lease, and contract lease. Okay, so the famous one that is obtaining at individual level is the contract hire. So contract hire, this is where you sign an agreement and utilize. Usually, it's under vehicles. You get vehicles from a company that manufactures or sells vehicles as a company, and then you have an agreement over a period of time utilizing those cars. Then after some time, after a given period of time, uh, you purchase, okay? You can purchase those cars or give back the cars to the company that you hired from. Okay. So as stated, you have finance lease, you have operating lease, and the contract hire. I've already stated that this is very common at the car companies hiring. Okay. So whenever you, as a company, it's very common actually in Africa where uh, Toyota is utilizing this kind of arrangement. Uh, Ford now, Ford Ranger is now under Toyota, right? Okay. So yeah, basically, so I'll just use an example of Toyota, which is existing in most of the countries. Okay. So Toyota is utilizing this kind of approach when offloading some of these vehicles on the market. And most of these companies also, okay, those companies that are getting vehicles from the showroom, this is the route most of them utilize to access those vehicles, operation of vehicles. Okay. Now, there is also what is known as finance lease. Okay. This comes in very handy if you want to uh, have access to a building, okay, where you can be operating from, and you don't have the funds at that given point in time to build your offices, your warehouses, etc. Okay, so for finance lease, it comes in very handy for the companies that are into exporting, also have I need of warehouses, especially at the ports, as well as the area where clearance is done, okay? The tax and customs clearance is done. So this comes in uh, very handy as well, the finance lease, okay? So you know that you continue importing from maybe abroad, say Japan, China, America, or better still South Africa or Nigeria, uh, and you don't have the muscle at that given point in time to build your warehouses by port. So what you do is you go into an agreement with the owners of those warehouses. Okay. So the agreement they for between 1 and 3 years. You pay the rentals respect to those warehouses. Uh, then at the end uh, of the lease period, you become the rightful owners of those warehouses. Okay. So what this simply tells is, it's like from inception, you are buying those warehouses, but you don't have the money and settle for paying on a monthly basis in terms of as if you're paying your rent. Okay. Now, the fact that the leaser knows that at the end of the day, that property will be yours. They are not interested in maintaining that asset. So the onus is on you again to start maintaining that asset. So even at the end of the tenure of the lease agreement, your asset will still be intact and you'll be in a position to continue utilizing it uh, to make your uh, profits and continue operating your business. Okay. Then the last one is what is known as operating lease. Okay, this is very common. This is what I wanted to specify as well in terms of when you're looking at capital intensive sectors, the medical sector as well as the construction sector. Okay, So for you to construct a road, you need heavy duty, those vehicles, those tippers and things like that. So there are organizations that already have these kinds of instruments. And if you are given a contract or a business to go into construction, you can settle for uh, this kind of funding. Okay, so the goodness with this kind of funding, you can have access to the instruments even when you don't have the money, but pay for utilizing that instrument as the monies are coming through. Okay. When you're doing road construction, okay, there's an agreement. Of course, they'll give you a certain down payment of, I think, 25%. I think that's the standard way of doing it. The 25% of what you're supposed to get. So in some cases, that is where you're supposed to do your mobilization aspects and also buying other equipment that you might need. But looking at this business, it usually needs a lot of heavy duty machinery. So the usually 25% is not usually adequate. So what do you do? You settle for this kind of arrangement. You approach those companies that already have these equipments. You agree with them. Remember when you get your contract to build those roads, okay? You know the milestones that you've been given. Once you do this segment, you're paid so much. So even you replicate what is stated in that agreement, where you are providing or the construction, and then replicate it the time frames with you, where you are signing the operating list. Better still, sometimes where you are doing the entity that you are constructing the road, or the entity that has given you the contract to construct the road, might take a bit of time, might violate what is in the contract. So you are better off also giving yourself a time frame, okay, maybe 2 months time frame or a month time frame, when you're doing the agreement with the operating uh, Lisa, okay, so that you give yourself room to get the funding maybe 2 months after the expected due date from the uh, entity that has given you the road construction contract. So those are the things you need to be aware of as you are signing, getting these finances from these financing visa and operating visa. Okay. So basically, these are the salient vehicles that you can use also under the capital market. So now I want us to look at the last segment. Okay. This is also very common in Africa now. Domestic markets, we know that nearly every one of us, we know that we can access loans from the commercial banks. Okay. These you can access long-term loans from commercial banks. Then on the international market as well, you can access these loans from international financial institutional loans. You can have international financial institutional loans as well. Okay. So a very good example is you can get Chinese construction loans from Chinese Construction Bank. You also have Chinese Agriculture Bank. You have the World Bank, etc. So I decided to just put a few examples here. So out there in the international market as well, there are financial institutions that specifically target certain sectors and uh, and fund those sectors. So you just need to do your market research very well and appreciate which financial institutions are out there giving out such loans. Okay, so I'll give you, for example, in my country, I wish I had done more research to appreciate other countries as well. There is what is known as a Zambia Development Agency. Okay, so the Zambia Development Agency, if you're running a business and you want to uh, have access to these kind of loans or vehicles, you can register with them and also state the sector you are from and what you want to do. So they will have your proposal and then also the quantums that you need in terms of monetary aspects. So once they identify uh, a suitable institution, international institution that you can get the funds from, they'll get in touch with you and facilitate that you ensure that you get those funds. They are also known as multinational institutions. I just decided to mention one. International Monetary Fund. This is one of the examples. However, for you to access these funds, you have to go through the recognized government institutions. So usually, this International Monetary Fund works with our government. But if you visit uh, most of your ministries, I hope those are the words that you use as well in the respective countries. If you government departments, you appreciate the packages that are available for you to access to these departments and get the loan that you need or the help that you need from these multinational institutions. So basically, this is what I have for you in this segment under the money market as well as the capital market. Depending on the level that you're at in your business, you can settle for which vehicle is ideal for you. Okay. I just realized that I think when I was populating my slides, I omitted the venture fund. Okay. So I'll just talk. The slide is not here, but for those people who are at the level where you just started your business, you can. Let me just go to the slide so that. Yeah, okay. So for venture funding, I've realized that the slide is omitted and also private entity. So if you are a startup, most of these vehicles that I've talked about are way out of reach for you. Why am I saying so? Okay. So for example, trade credits, you might utilize it. Working capital loans, you may utilize it, but the likelihood of getting access to this bond is very slim. Okay. So why am I saying so? For you to get working capital loans, you are required to have a long-term relationship with the commercial bank that you have an account with. So before they even give you these loans, working capital loans, they'll appreciate how long you had an account with them and also uh, uh, how the account has been performing. So as a startup, this is not something that you can easily access. Commercial paper as well. This is usually issued by big institutions or big businesses that are well established already and are doing very well on the market because it's an issue of trust. Okay. Secured loans, most of the startups, they don't have uh, equipment, okay, adequate equipment that they can utilize as the collateral. Okay, so this one also is something that is difficult for startups. Debt securities, something that you can't do. Equity financing, there are requirements that you need to meet for you to issue securities, and usually these are also for big businesses or companies, which leaves us much to venture funding. You can also utilize the trade credits, okay? And then after some time, maybe after saving, uh, being with a respective bank for some time, you can try and get the the secured bonds as well. Okay. So venture funding, you have a lot of there's this term used as angels. Okay. So there are a lot of international institutions, even local, those people who have a lot of money, but they don't know what to invest in and where to place the money. These are usually called angels. Okay. So these are usually on the lookout, looking for startups that have potential to grow. They will invest in such businesses, and then also depending on the agreements, they can become part and parcel of directors or shareholders of that business, or you can agree on just giving them, like they just invest the money, and they're just interested in getting the profit aspect, okay, depending on what you agree upon. So this is very cardinal for startups to identify angels in the market. I'll give you a site where you can find a lot of these angels. Uh, there's there's a site called uh, NGO Africa. Okay, try and go to that website. You find a lot of packaged financing programs that are there for startups, as well as just capacity building, trying to get you capital through uh, these vehicles of angels. Okay? But angels are also found on that platform. So try and access that platform. You'll find a lot of uh, yeah people who can try and fund your businesses. Then there's private equity. So private equity as well, it's just basically companies or individuals that have money, okay? But they only place the money in companies that have been existing uh, for a while. Now, these companies are companies that are not listed on the stock market, okay? So they will invest in such businesses, and yeah, depending on the agreement as well, they might just be there to for the profit, or uh, be part and parcel of the shareholder. So you need to be very vigilant and try and find uh, these entities that are looking to partner with the other companies in your local setup as well as international setup. This has also become very common, the private entity as well. There are a number of companies, especially from Europe, that are on the market trying to find companies that they can invest in. There are a number of them actually. So recently, I'm actually still working on it. There is a company in my country that's trying to look at drones, okay, agriculture, monitoring the agriculture sector using the drones. So they're getting funding from Europe, one of from Europe. There's a company that identified them from Europe, and I'm trying to facilitate that they're able to start to the Zambia Development Agency that I talked about. So these private entities, most of them actually, they're coming from the foreign market, okay, Europe and America, but I'm very cognizant of most of them coming from uh, Europe. So for those of you who might want to know the details of this company that I'm just talking about, you can get in touch through Maya, and I can give you the details so that you can start your conversation and see how best you can be assisted through this avenue. Okay. So basically, this is what I wanted to share with you this morning for some countries and this afternoon for the other countries. So in case there are any questions, you can go ahead and ask the questions that you have. Are there any questions?
Anyone has questions, you can go ahead and unmute yourself. You don't have to put your hand up or anything, just ask away.
Let me see if there are questions here where there's a chat. Where it's saying chat. Okay, so okay, I can see one. I can see one question relating to a small company
Great.
from Azita. Okay, she says, I'm a small company. I still get stuff from opting for the loan. First, for the fees applied are high. There's an assessment that I have to. Okay. Okay, I'm trying to go through the comments. Okay, so basically there are no questions that I'm seeing on my end. I'm not seeing any questions. I hope I won't, if I do this, I won't. Okay.
Yeah. Would you like to carry on, or is that have you got anything else to go on?
Okay, basically, yeah, no, my presentation is done. This is what I wanted to share with the group.
Okay, no problem. Does anyone else have any comments, questions? Anything like that?
Oh, lovely.
No? Okay, well, I guess we can maybe leave it there then. Thank you, Dr. Ndidi. It's very, very glad to have you here. I found this really interesting. Really got to look at yeah, as Judith said, you explained everything so clearly. Really went into detail, so we'll thank you for that and thank you for your participation. I'll be sharing this recording in the group chat, so anyone can watch it again, and yeah, I'll just make it available for everyone. Okay, well, I think if you'd like to say a few words, Doctor.
I'm trying to get my video back on.
All right.
Okay, so thank you very much for having me on this platform. I look forward to more interactions where we look at other segments in
Drawing connection issue. Okay, good words to finish the lesson. Um, we'll give her a few minutes, and then if not, we'll just have to leave it there, I guess. Yeah, if you have any comments, anything you'd like to say about the masterclass, please let us know in the comments. Yeah, I think he's just left. We'll give it a couple more, 2 more minutes, and then if not. All right. Well, that's a shame, but I think we'll have to leave it there. If you had any other words that you want to let me know, I'll tell you in the group chat. I'll be the messenger. But for now, I think we can leave it here. So thank you everyone for coming. Um, if you are French speaking, I am sorry about the presentation, the masterclass for tomorrow, but it won't be happening. She had to cancel, unfortunately. But thank you all for making it tonight, this morning, sorry. And I hope you all have a great weekend. Bye, everyone.